Okay, Glass. Today we're going to be learning about financial management. We'll basically talk about the objectives, the various fields and scopes of finance, and finally we'll discuss conclude with what is the difference between profit maximization and shareholder maximization, and how shareholder maximization is actually better. So, what is finance? Finance is basically the management of money. It involves creating, allocating, and management of financial resources. It is a crucial aspect of business and it has to do with planning and control of financial resources. Until the 1890s, it was actually a branch of economics. So even right now, it relies heavily on economic theories. Rather, as we'll go ahead and study different theories, capital structure theories, cost of capital theories, you will see they almost move as economic theories and have as many assumptions of rational and information availability as the economic theory does, right? So, what are the objectives of knowing finance, or why do we study finance? We want to understand financial systems. How do market, institution, and financial systems work? It helps us make financial decisions. The ability to make sound financial decisions is both important for individuals as well as businesses. Investment and portfolio management decisions. So, where to invest, how much to invest, how long to invest. Principles of investing, asset management, development, and diversification of portfolio. All these are within the scope of finance, and all these are essential for us to learn so that we can not only better manage our portfolio but also provide financial consultancy and advisory services to others for which we can earn a good amount of money. Then, so basically, corporate financial knowledge is also very important. That is basically how corporations raise, manage resources, and create value. This basically has to do with cost of capital and capital structure. Cost of capital is about how do you finance a company's operations? Do you use debt or equity? Cost of capital is at what rate do you raise these funds? Right? Another objective is risk management that has to do with insurance, derivatives, hedging strategies. The basic idea here is to minimize loss as much as possible. Risk is the uncertainty of return. And the objective of risk management is that this uncertainty is minimized or mitigated. When we say mitigated, it means that it is transferred in such a way that it does not harm or does not cause a devastating harm to the business organization in case the risk incurs. Then there's economic and financial analysis. One of the main objectives of financial analysis is to see how well the financial company is doing, make financial statement analysis, compare various economic indicators, see market trends, right? Then see, ignorance of a law is no plea for not following the law, right? So in finance, there are a lot of ethical and regulatory compliances that need to be met, right? The legal consideration, the laws, rules, and regulations. So for ethical and legal reasons, also we need to make sure that we are following the accounting systems, and learning about this is also one of the objectives of finance. Personal financial planning, you all are going to one day start earning money yourself, and how to manage your finances in such a way that you can maximize your wealth and have money for retirement, house, not get into too much debt is also very important, right? So, to handle these diverse roles in finance, from corporate finance to investment banking to personal finance, economic policy and advising is the main objective of finance. Now, we'll talk about the scope of finance. Now, traditional areas of finance, or traditionally how finance is divided into corporate finance, that is financial management of a business, investment, that is management of stock, bonds, real estate, financial markets, that is to do with trading, stock exchange, financial institution, bank, credit unions, insurance companies, public finance, government revenue, and expenditure. So these are the broad five categories that we divide finance into when we talk about the traditional methods of dividing finance. Now, there are also certain functional areas. If you look at what are the various roles that a financial manager plays, you will see that there's financial accounting, right? That is basically recording and reporting on financial transactions. Then, as a functional area, the next step obviously is financial analysis. That is determining how well the company has done, and that helps us make decisions. The next obvious stage in a functional area of finance is financial modeling, where you try and forecast what the future trend is going to be like, what are the expected sales, costs, and stuff like that. Portfolio management, managing your investment portfolios. Portfolio is nothing but a collection of securities or investments. They can be debt securities, they can be equity securities. Financial regulations, so oversight and compliance is another completely different area of financial management. Now, there's certain specialized area of financial management, one being personal finance, right? This has to do with the individual's personal financial needs. So, making money for somebody's kids' education or arranging money for somebody's house, right? Then there's asset management. Asset management basically has to do with the management of investment portfolios. And then there is wealth management. Wealth management is basically service that is provided to high net worth individuals, people who have their income in crores, right? So they don't only need to manage their portfolio, they also need to maximize the value of their portfolio by allocating it among different asset classes. So when we'll talk about asset management, we'll be talking about equity portfolios or debt equity portfolios or maximally debt equity and government market portfolios. But wealth management is a whole wider spectrum. It has to do with investment in private equity. It has to do with investment in things like real estate, right? Another specialized area of finance is taxation that has to do with compliance with taxation laws. And the next one is financial planning. That is what has to be done and how much money has to kept aside in which instrument for how long to achieve your financial goals. Right? These are some additional certification courses that I would like you to pursue along with your MBA. The first one is Chartered Accountants. It specializes you in taxation and compliance. The next is Chartered Financial Analyst. It specializes you in portfolio management. Then there is Certified Financial Planner. It makes you certified and a specialist in personal financial management. So the difference between Chartered Financial Analyst and Certified Financial Planner is that Chartered Financial Analyst would handle the back end of the whole industry. So after the funds have been collected, how it needs to be channelized and invested by a mutual fund company or an insurance company will be handled by a chartered financial analyst. Where certified financial planner would be the front end role. He would actually interact with the investors and make sure that sufficient money is there for their financial needs. Then there's certified cost accountant, certified management accountant. So they're basically cost and work accountants. So if you liked cost accounting in your previous semester, it will be helpful for you to be doing this. Then there are various NISM certificates in mutual fund distribution, insurance sales roles, personal financial advisories, and with these certifications and clearing these certifications, you can create a job opportunity for yourself. Right. Then there are interdisciplinary areas of finance, international finance, that is financial transactions across borders. This would have to do with foreign exchange market risk and the likes of that. Then there's a beautiful intersection between psychology and finance called behavioral finance. And that has to do with how financial decisions are influenced by our thought processes and feelings. Then there is financial technology of FinTech, that is the integration of finance and technology that we are seeing all around us in the form of UPI payments or even online banking. Then there is risk management. Now, risk management is not only about financial risk, it is also to do with fraud and other risks that one might be exposed to. Then there's sustainability finance that is measuring how good or effective the company has been in reducing its carbon emission or increasing its energy efficiency or producing more electricity and saving on resources such as water and other pollutants. Now, there's certain emerging areas in finance. The first one is cryptocurrency and blockchain finance. Now, this is a subset of fintech that allows you to record transaction in multiple ledgers. So it is decentralized ledger. So for example, the same transaction would be recorded in several places. What would happen is that if you want to alter one transaction and create a fraud or commit a fraud, you will need to alter that transaction in every ledger in which it has been recorded, which would make making which would make forging a transaction almost impossible. Then there is green finance, that is raising money for investing in environmentally friendly projects. Then there's social finance. Social finance is investing in activities or raising funds to invest in activities that have a social impact, such as the upliftment of poor, taking care of the disabled, right? Then there is Islamic finance. Now, Islamic finance is a very interesting form of finance because in Islam, taking interest is considered to be a form of sin. So, how these Islamic financial institutions work is that they buy assets at a lower price and then sell them to the borrower at a higher price for which they offer them a loan. So the difference between the charge at which the bank acquired the asset and the price that it for which it sold the asset is basically the banking charges. Then there's digital and mobile banking that is revolutionizing this world. Now, there's a difference between profit maximization and wealth maximization. Let's dig into it. So, profit maximization is basically maximizing the profit of the company. The profit of the company is nothing but total revenue minus total cost. So the basic idea here is to maximize the revenue and reduce the cost as much as possible. So we were talking about things like increasing pricing, sales, reducing expenses, right? Now there are certain limitations of profit maximization. They're basically short term and only immediate gains are considered. They neglect long term sustainability, right? They neglect stakeholders' interest. Okay, so there's a difference between stakeholder and shareholder. Shareholder is a person who owns a share of the company and is technically the owner of the company. Stakeholder is anyone who has an interest in the company. So a customer, an employee, anyone is a stakeholder. Even environmental groups whose environment is being polluted by the company or factory are also stakeholders. So in profit maximization, what we will try and do is we'll try and maximize the revenue and try and cut cost everywhere, which means we might cut costs in environmental friendly projects, we might cut cost in research and development, right? So all those things do not take into account the interest of all the members involved in the business activity or all the people who are influenced by the business activity. So in a pursuit for cutting costs we might even compromise on the quality, right? So profit maximization is very short term. So we wouldn't mind even compromising on quality, although it would cost us in the long run to compromise on the quality. It ignores non-monetary goals, right? So environmental responsibilities are not directly tied up to profits, and they are called basically uh, externalities. These are basically costs that somebody else needs to pay. But profit maximization pays little to no emphasis on it, right? Then there are ethical and legal concerns. For example, to cut costs, the company might start paying its employees below minimum wages. That would maximize the profit, but that will not be good for the employees. Then there's market competition. Profit maximization only takes into account the revenue and the total cost. It does not take into account the fact that how much market share do we have, are by cutting costs and reducing quality, are we losing market share, right? And then there are external factors, right, that influence profit maximization. So economic and market fluctuations, these are not considered in profit maximization. Then there's a limited perspective about how value is created. So shareholder wealth creation is a broader term. It basically means maximizing the wealth of the shareholder. Now, shareholder wealth is nothing but the share price of the company into the number of shares that that any person holds. Now, if we assume that no new shares are issued, the only way to maximize the wealth of a shareholder is to either declare dividend or to increase the share price of the company. So shareholder wealth maximization takes the view that you should, as a financial management manager, take such decisions that the wealth of the shareholder or the share price of the company or the dividend is maximized. Right. So advantages, what are the advantages of shareholder wealth maximization? It is a long-term focus because investors will not be pleased by immediate profits. They also look into the long-term prospects of the company. Right. It has alignment with stakeholders' interests. So, for example, if a company has is practicing green practices, as we are seeing in the case of ESG, right? So we will see that uh, investor activism is actually promoting these companies and increasing their share price. So instead of just narrowly focusing on increasing revenue and cutting costs, other people in interest like employees, environmental groups, they would also be taken into consideration. Right now, because the prioritization is not just immediate returns or maximization of revenue, but higher returns over long period, it improves the efficiency of resource allocation. Right? Then there's market competition. So profit maximization was only looking at the company's performance. But when the share price of the company is being evaluated by the share market in general, they basically take into account also facts such as what is the competitiveness that the company is facing, what kind of losses are expected, how much market share does the company have, right? So it boosts investor confidence. So if we follow a principle of shareholder wealth maximization, we it would become easier to draw in shareholders and gain access to finance, right? It enhances the corporate reputation. So if a company has good share prices, its reputation in the market will also improve. For example, in the case of Reliance, that it is known as the wealthiest company in India, that or the most valuable company in India at one point in time, or even now, is something that gives it an edge, right? So it also stimulates economic development, right? Because if the company is not only looking for immediate gains but also for long term benefits of the society at large, it will lead to job creations, increased tax revenue because there'll be more compliance, right? It promotes accountability. So what would happen is that the in case the company or the management does not perform in any dimension, ESG or any factor, then they would be held responsible and they'll immediately see a reaction in the share price of the company almost on a daily basis, or not on a if not on a minute by minute basis. But uh, in profit maximization theory, that effect will slowly creep in or might not even creep in, right? So profit maximization is short term, whereas wealth maximization is long term. Profit maximization's main objective is to increase revenue and minimize costs, whereas wealth maximization is to enhance dividends and stock market appreciation. Profit maximization focuses on accounting profit, whereas wealth maximization focuses on cash flows and risk adjusted returns. Right? Profit maximization ignores the interest of all the stakeholders, whereas wealth maximization balances the interest of all the stakeholders. Profit maximization ignores risk, whereas wealth maximization considers risk, uncertainties, and cost of capital. Profit maximization too might actually lead to a lot of unsustainable practices that do not lead to immediate gain. That unsustainable practices that only lead to immediate gain. Right now, wealth maximization is more successful in terms of long-term success of a company. Now, profit maximization might lead to certain use of unethical practices like underpaying employees, uh, overlooking environmental clearances, or not complying with green regulations. So all these things can avoided in case of shareholder wealth maximization, where ethical practices are given due consideration. The main aim of profit maximization is to increase net income or accounting income. Wealth maximization, the objective of wealth maximization is to increase stock price or dividends. Now, profit maximization, if the company is continuously profiteering, somewhere people would feel that it is being unfair because it is taking more from society than it is paying back. So it will erode the stakeholders' interest. Whereas in wealth maximization, because we are looking at all the shareholders or all the stakeholders' interest, because all of them influence the share price, so it would be better for the company and would enhance its reputation and attract investors. So profit maximization is less focused on long-term growth, whereas wealth maximization encourages innovation and strategic growth. So profit maximization is short term, whereas wealth maximization is more holistic, sustainable, and takes into consider strategic approach. So by prioritizing wealth maximization, companies can ensure operational financial performance and strategic decision making that align with the long-term success and stability of the investor. So these are the functional areas of management manager in a modern age, right? Now, the role of a manager is changing mainly because of technology, globalization, and shifting priorities. So here are the key functions of a financial manager. The first one is financial planning and forecasting. This basically has to do with preparing budgets. That is like making a plan as to what the financial expenditure might be, forecasting as to what the expenditure might be in the future, strategic planning as in how much money would be needed when and how to arrange that, capital management that has to do with how much funds from where the funds have to be raised, how the funds have to be allocated, and working capital management that is day to day cash and expenses management and budgets. It, there's also risk management, so financial risk analysis that is looking at the currency fluctuation or credit default risk. Then there's mitigation strategies, taking up things like insurance, derivatives, getting into diversification. Or doing all these things is also one of the functional areas of a manager. Then there is investment decision, which basically has to do with asset management, as in what is the quality of assets that we have invested in. And then there is portfolio management, as in which asset classes have we invested in. There is regulatory compliance that a financial manager needs to adhere to, that is adherence of law and transparency. Then there's technology integration. Financial managers are increasingly being asked to automate the entire accounting process and do data analysis using automated processes. Cost management and profit maximization. One of the main objectives of a financial manager or a main job of a financial manager is to control costs and improve profits. Stakeholder communication. So in most companies, there's an entire team that is dedicated to just making annual reports, checking it, rechecking it, adding it. So entire strategy department works just so that it can have a clear communication with investors and maintain good relationships with them so that it becomes easier to raise finance whenever it is needed. Now, sustainability and corporate reporting has also emerged as a major area of uh, financial accounting, right? So, green finance, that is sustainable investing, compliance with ESG norms and standards, ethical financial reporting practices, all these need to be adhered to by a financial manager. Global financial management, that is management of foreign currencies, global taxation strategies. So there are different tax rates that a company has to pay depending on where it's registered and where it's earning its income. So basically deciding where to base its head office is also a very important decision that financial managers need to make. So financial managers are strategic partners and financial experts that are advancing technology. Now, broadly speaking, there are only three financial decision areas that are long-term financial decision areas. There's investment decision, as in where the money of the company should be invested. These are basically capital budgeting decision and need to be taken very carefully because once made, they are irreversible, or if reversible, then at a very high cost. Then there's financing decision as to where, how, and when, how much money has to be raised at what rate. That is basically financing decision. Then there's dividend decision. That is basically once the profit is generated, whether it's supposed to be retained by the company or distributed among the shareholders. Right? Investment decision is basically a capital budgeting decision. It has to do with allocation of monetary resources to various projects and includes selecting new projects, asset acquisitions. So, for example, how much real estate or machinery to acquire, portfolio management, which companies should invest in. Now, the key consideration while making an investment decision is to look into the risk, return, cost, and time horizon. Financial decision is basically deciding on what is the best way to fund the company and what is the optimum mix of debt and equity, that is internal funds and external funds, right? All these things influence whether how much loan we'll be able to access, how much retained earnings, and how much external financing will require. So the key consideration in financing decision is the cost control, how much debt we already have, and market condition. Dividend decision is a decision to distribute the profit of the company. So it depends on a lot of things such as dividend payout ratio, stock repurchase. So whether we want to buy our own stocks back to enhance the share price, whether we have reinvestment opportunities or not. So when we are making dividend decision, we look into the expectations of the company of the future, whether the company has its profit in the form of cash or not, liquidity, whether there are opportunities to invest or not, and what are the tax consideration of declaring a dividend. So there's also short-term financial decision making, that is liquidity decision. That is a trade-off between profitability and liquidity. So we can either make investment in long-term instruments that are profitable, or we can keep cash with us and lose on that profitability. So we have to look into the firm's future cash requirements and making sure that the money is there when it is needed. Working capital management is liquidity and day-to-day operational management. It has to do with bank balances, receivables and payables management, inventory levels. In these things, we look into things like cash flows, credit policies, and the efficiency of collections. Risk management is basically the currency risk, interest risk, and insurance. Currency risk is the risk that the for a country that is engaging in international trade, the exchange rate might change. So something that is cheaper today in dollar terms might actually become more expensive in rupees terms, just because the rupee depreciates or becomes less valuable compared to a dollar. Then there is interest rate risk. So what will happen here is interest rate fluctuates. So whether we have optimally raised the debt or not will depend on whether debt rates have fallen or increased. So basically, there are two kinds of debt structures: floating, where based on the changes in the repo rate or the central bank interest rate to the banks, the interest rate also changes. And then there is a fixed interest rate regime, where basically a fixed amount is charged for a particular tenure, irrespective of what the interbank or central bank to banks interest rate is. Right. Risk management also has to do with how much insurance should we take, what should be its charges. Right. Then risk management basically depends on how much risk are we able to take, what is our risk appetite, how volatile is the market, whether we are able to meet all the compliances or not. Then there are also various strategic decisions that a financial manager needs to make, right? So it has to align its financial policies, as in how much money is going to raise, from where it is going to raise it, how it is going to invest it, with the long-term goals of the organization. So if the organization wants to penetrate into a particular industry, the financial manager would have to plan accordingly. So it would have things like mergers and acquisitions, market entry and exits, diversifications. Now, key considerations are profitability, trends, competitive advantages, right? So, finance as a decision making area is very interconnected and has to take into consideration a lot of facts, short term as well as long term, while making its decisions.